Good morning. Thank you, Manisha, for that kind introduction, to the State Secretariat for International Finance, and to Elevande for the opportunity to present at today's forum. This collaboration is incredibly important, and as you know, Elevande means to lift up in Latin. Coincidentally, the New York State motto is Excelsior, which means even higher. We have today a forum for promoting collaboration between the public and private sectors so that together we can promote responsible innovation and through that collaboration raise standards for both consumers and markets. The FinTech sector presents potentially the opportunity to create economies of scale, to facilitate transactions in an instantaneous fashion, and to bring people into the economy who historically have not been able to participate. I've been advocating for and implementing policies to expand opportunities for financial inclusion my entire career, and the potential for DeFi and FinTech makes me generally very hopeful for the future. But there are challenges that regulators, innovators, and investors must confront and address as well. I don't need to describe to this audience the events of last year's crypto winter, or the concerns that academics, regulators, and innovators alike have raised about expanding AI and machine learning. How do the events of last year impact a regulator's view of cryptocurrency and FinTech more generally? How is it likely to impact regulation and enforcement? These are questions that innovators, investors, and policymakers alike continue to wrestle with. How should regulators respond? At DFS, we regulate nearly 100 banks, 17 GSIBs, thousands of insurance companies, mortgage, student lending, pharmacy benefit managers, and others. And we are the only prudential regulator with virtual currency-specific authority in the United States. We have in place, out of New York's DFS, the most comprehensive virtual currency framework in the United States and perhaps in the world. Our virtual currency regulatory architecture includes strict licensing, supervisory, and examination standards, as well as enforcement authority. DFS-regulated virtual currency entities are subject to capitalization and reserving, cybersecurity, BSA, AML provisions, and consumer protection requirements. Once licensed, companies are subject to rigorous and transparent pre-approval processes for every new product, new listing, or material change in business. And every licensed company is subject to a bespoke supervisory agreement meant to address its unique risks. New York's framework has proven its value in terms of consumer protection by shielding New Yorkers from the effects of the crypto winter. Not FTX or Voyager or Celsius were licensed to do business in New York. Our framework also provides a vehicle for legitimacy for innovators and investors seeking the kind of clarity of rulemaking that DFS has originated. Our framework has served well to protect consumers, keep virtual currency entities safe and sound, hold bad actors accountable, but most importantly, allow for innovation and marketing of new products compliant with our standards. This prudential regulatory approach should be contrasted with an approach based only on penalizing bad actors. Instead, we provide transparency. The first-in-the-nation guidance that DFS put in place sets foundational criteria for U.S. dollar-backed stablecoins issued by DFS-regulated entities. The guidance outlines our expectations with regards to reserves, redemption policies, and independent audits. I also have directed the issuance of new guidance establishing the use of blockchain analytics tools as a best practice for virtual currency entities to prevent and manage risks and suspicious activities, providing companies with an efficient and data-driven way to conduct customer due diligence, transaction monitoring, and sanctions screening. We have guidance on resolution, and we've brought some of the heftiest enforcement actions in the country. To carry out this work, however, DFS has built the nation's leading and most experienced team of virtual currency experts who license, examine, and supervise entities, and work to ameliorate risks before consumers are harmed and enforcement actions become necessary. This is not just about regulations and the black and white of the law, but a regulator's ability to operationalize. When I came into the department, the virtual currency team was no more than a handful of people, and today it is more than 60 professionals, numerous pieces of guidance, assessment authority, and cutting-edge technology that we ourselves use as regulators. One journalist said that New York used to be the place where crypto went to die. But it turns out that New York is the place where there are no bodies to be found buried. And our approach has been validated in investment statistics, where in 2021, nearly half of private investment in cryptocurrency was in New York regulated companies, more than 2x Silicon Valley and 8x Miami. But as we look to the future, we should learn from the past. We should ask what we can do to ensure that these same types of prudential standards that we carry forward in our BIT license to protect consumers from harm are still fostering innovation. And of course, that applies as we look to artificial intelligence and machine learning, where there are lots of potential benefits, but also risk of harm. When I say that DFS is looking at AI and machine learning, it's not limited to how we evaluate private sector use of those tools. My vision is for DFS and other regulators to become the regulator of the future, meaning that we are embracing RegTech to the public advantage, using data-driven approaches that leverage data analytics to enhance our ability to predict and respond to events in the marketplace. There are several steps to this process and questions that we as a regulator must ask along the way. The first part is to procure the hardware that we need to operate these systems and hire professionals with the knowledge and experience to run the programs. DFS is currently in the process of procuring a supercomputer to enhance our processing power. We're also executing contracts and hiring top talent. So for any of you seeking to join a progressive regulator, consider come working for DFS. The next part of the process is questioning how we get the data from our entities that we need to regulate. How do we collect and structure it properly? We're hiring a deputy superintendent for data governance to work with our research and innovation team and our chief technology office. All of the major players in private tech and software are moving toward AI, that's no secret, but it would be a huge missed opportunity for regulators to not make use of these tools as well. An example of how AI could be used to enhance oversight is, of course, with blockchain. What data sets do we use to look at threads of behavior, and how can we use it predictively? But of course, blockchain is but one area where regulators should be using machine learning and artificial intelligence. We're pursuing the use of these tools in other contexts as well, from health insurance to climate to banking supervision. We're taking steps to use the awesome potential of this technology so that we can efficiently interact with the public as well as the entities we oversee. Most of the guidance out there for artificial intelligence and machine learning, whether we're talking about President Biden's blueprint for the AI Bill of Rights, or DFS's own circular letter on informational sources, or the guidance we've issued on artificial intelligence and underwriting in life insurance, emphasize that safeguards should consider not just the inputs to the system, but the real-life results of machine learning processes. Here we should all be concerned not just with the letter of the law, but with the spirit. For example, the journey of the consumer through the whole process of buying or being solicited for a product, as well as the use of that product by the consumer in the marketplace. When it comes to establishing regulatory frameworks, you would usually see the process go in stages, where innovation happens first, and then capital flows, and lastly, regulators respond. Now we are in an era where innovators are asking the regulators to help establish the rules of the road as they innovate. We need to consider together where the road is going, how fast we can drive, and what the tolls will be. DFS, however, is only one regulator, and our responsibility is over banks and insurance companies and crypto firms. And of course, other agencies will have to figure out how they use AI in their own oversight and determine how it should be used in the entities they oversee. But regulators themselves should be innovators. At DFS, as I noted, we are building the regulator of the future, identifying, surfacing, and synthesizing data about markets, market breakdowns, and market reactions to regulation. This is hard, of course, in innovative spaces where there is less data to pull from, but that is why we are so committed to stakeholder engagement and working across sectors to surface the information we need to be a powerful regulator. It's not enough just to have clarity with rules and guidances on the books, but regulators must then walk the walk, not just talk the talk, and operationalize the rules we put in place. That is how you strike the balance between protecting markets and consumers while also allowing for responsible innovation in the marketplace. I very much look forward to the discussion we're going to have today, and thank you so much for attending.